Welcome, curious minds, to another deep dive. Today, we're pulling back the curtain on a company that literally lifts billions of people every single day, yet, often goes completely unnoticed.
Right under our noses, or, well, under our feet, technically.
Yeah. We were talking about Otis Worldwide Corporation, ticker symbol OTACE. We've been digging through, everything. Business quality analyses, financials, even what actual customers are saying online. Our mission today, uncover the, frankly, surprising truths about how a company like Otis really makes its money and how it protects its spot, its market position, and maybe what's next for them.
Yeah.
And here's a little teaser. The main product, the elevators themselves, they're kind of like a loss leader, which is not what you'd expect at all.
Not at all. It's fascinating, really. This deep dive is going to reveal this sort of razor and blade model, but in an industry that's just constantly moving billions of people. And the numbers, they tell a story that goes way beyond just, simple sales figures. It highlights a really unique economic engine. Right. The business model. A surprising flywheel.
Okay, so let's unpack this. Otis's model, at its heart, seems remarkably simple, but also really, really durable. It's basically built around two parts, right? New equipment and service.
That's it. The new equipment side is pretty straightforward. Designing, making, selling, installing elevators, escalators, moving walkways, all the new stuff.
Right.
But this part is very cyclical. It goes up and down construction trends globally. And importantly, the profit margin isn't that high. It's really the way in.
The way in. Okay. And then there's the service segment. This is the maintenance, the repairs, the modernizing of existing elevators, their own and competitors sometimes.
Yes. And this is where the magic happens. This is Otis's, their economic engine. It throws off stable, recurring cash flow, high margins, all locked in with long-term contracts.
Okay, so how different are we talking?
I bet.
Financially.
Oh, it's stark. If you look at their 2024 results, service was about 62% of the total sales. So $8.9 billion out of $14.3 billion total.
Okay, a bit over half the sales.
But, and this is the kicker, it brought in over 90% of the profit. We're talking $2.185 billion in profit from service out of $2.514 billion total segment profit.
Wow. So, new equipment, less than 10% of the profit despite being nearly 40% of sales?
Precisely. It really shows you where the value is created and captured in this business.
So the CEO, Judy Marks, she uses this flywheel analogy. That makes a lot more sense now. Can you explain that a bit more?
Yeah, it's a great analogy. The idea is simple. Selling the new equipment, even at a low margin, is the initial push. That sale gets the flywheel spinning.
Okay.
And once it's spinning, it unlocks decades, literally decades, of that super high margin service revenue, repair, maintenance, upgrades. It just keeps generating cash.
It feeds itself.
Exactly. And this whole model is sitting on top of some really powerful long-term trends, things that aren't going away. Well, first, urbanization. The UN says 68% of people will live in cities by 2050. More people in cities means taller buildings, denser living.
More elevators.
Right, guaranteed demand. Second, the elevators already out there, they're getting old. The installed base is aging. And fixing or modernizing them isn't really optional for building owners. It's not like deciding whether to renovate the lobby. This creates this non-discretionary need for modernization services. That market's expected to grow from about 8 million units needing work now to over 10 million by 2030.
Big numbers.
Huge. And finally, elevators aren't just convenient, they're critical life safety systems. Governments regulate them heavily, mandatory maintenance schedules, inspections.
The demand is resilient. It doesn't just disappear in a recession.
Very resilient.
Yeah.
Largely insulated from economic cycles. People need elevators to work safely all the time.
Okay, so this brings up a big question for you, the listener. If this service business is such a gold mine, how on earth does Otis stop competitors from just swooping in and taking it? 2, the fortress. How Otis stays ahead. Which leads us nicely to this idea of an economic moat. Like a castle fortress protecting the business. What's Otis's moat made of? Seems pretty strong.
Oh, it's formidable. It's built mainly on two things. Really high switching costs for customers and intangible assets, basically. Their brand and reputation.
Okay, break down those switching costs.
Yeah.
Why is it so hard for a building owner to just, hire someone else cheaper?
Well, multiple reasons. First, Otis, as the OEM, the original equipment manufacturer, they just know their machines inside out. They have proprietary technical knowledge.
Right.
They also have special diagnostic tools. Technicians apparently call it the blue tool. You need it to properly talk to the elevator system sometimes.
Proprietary tech. Like Apple with their repairs.
Kinda, yeah. Plus, they have the full inventory of specific parts readily available. Now, if you're a building owner, thinking about switching to maybe a cheaper independent provider, there's significant risk.
How so?
More downtime if the third party doesn't have the right part or tool, potential safety liabilities if something goes wrong. And think about it, the elevator service contract is actually a pretty small slice of a building's total operating budget.
Yeah, probably tiny compared to energy or cleaning.
Exactly.
But
a broken elevator, that's a major headache. Huge disruption. So the incentive is strong to just stick with the guys who made it, even if they cost a bit more. Less risk, less hassle.
And the proof is in the pudding, right? That retention rate.
It's incredible. A 94% maintenance contract retention rate? Think about that. 94 out of 100 customers choose to renew year after year.
That is just staggering, especially as we'll get into. When their service isn't always universally loved, it really hammers home how sticky those customers are.
And what's really interesting is this moat isn't static. They're actively making it wider.
How are they doing that?
2 main ways. First, digitalization. They're pushing hard to connect their elevators to the Otis One platform. It's their Internet of Things system.
IoT for elevators.
Yep. Predictive maintenance, cloud data analytics, find problems before they happen. Their target is to get over 60% of their service portfolio connected. And management actually expects this to boost that global retention rate by another percentage point.
Wow. Okay. Makes it even harder to leave if Otis knows your elevator better than you do.
Precisely. Second, they've actually been gaining market share in new equipment since they spun off in 2020, about 3.5 points globally.
And each new elevator sold
feeds directly into that high-margin service base for decades to come. It reinforces the whole flywheel and widens the moat over the long run.
So next time you're in an elevator, maybe in your office, apartment building, the mall, just think about the complexity humming away behind the walls. And remember, the cost for that building manager to switch service providers is not just about dollars and cents. It's operational risk. It's safety. It's a massive headache if it goes wrong. Makes you appreciate when it just works. 3, customer and employee realities. Tolerated, not loved. Okay, let's shift gears a bit. Talk about the human side. We did some scuttlebutt investigation, basically digging through online reviews, forums, talking to people, trying to get the real story.
The ground truth.
Exactly. And we found something kind of paradoxical. Otis's services, these seem to be generally tolerated maybe rather than loved.
Yeah, that's a good way to put it.
And funnily enough, that fact actually highlights how strong that moat really is.
It does. The customer sentiment is definitely mixed. You look at places like the Better Business Bureau, Mouth Shut, even Reddit. You see the same complaints cropping up.
What kind of things?
Slow response times when something breaks, elevators down for way too long, billing errors that seem to persist. There are specifics too, like Otis had to pay over $600,000 to settle a False Claims Act case for allegedly billing for services they didn't even perform.
Oof, not great.
No.
Yeah.
And there was a recall for some home elevators because of an entrapment hazard, so these aren't trivial issues.
Right.
And here's the dissonance. Despite all that 94% retention rate just holds steady.
So customers complain. They might be unhappy, but they stay.
It strongly suggests they feel stuck. Like, okay, this isn't perfect, but switching feels riskier or maybe just impossible. They feel they don't have a better, safer alternative.
That's a really interesting tension. Okay, What about the people working at Otis? Do the employees feel the same way, or is it a different picture inside?
It's definitely a more balanced view from employees. There seems to be a genuinely strong culture around what they call the Otis Absolutes safety, ethics, quality. You see that echoed a lot.
That's good, especially the safety part.
Crucial in this business. Mechanics on forums often praise the internal support they get, and that deep-seated safety culture is mentioned frequently. On Terribly, about 70% of employee reviews were positive. Lots of long-timers see it as a solid place to build a career.
Okay, so mostly positive, but are there downsides mentioned?
Oh, yeah. It's not perfect. You hear critiques about corporate bureaucracy, red tape, management pressure. Some departments, like engineering, apparently have issues with high turnover. So it's a mix. Good, solid company culture in some ways, typical big corporation issues in others.
Right.
But here's something interesting that connects back to those customer complaints. There's this kind of untapped opportunity there for Otis.
How so?
Well, think about it. Every time they have an inefficient service called slow response, repeat visit that costs Otis money directly.
Operational cost.
Exactly. So they have this internal efficiency program called Uplift, aiming for $230 million in savings. And the Otis One IoT platform we mentioned, that also helps make service more efficient.
So by fixing their own service delivery problems,
they lower their own costs and they make customers happier. It's a potential double win. Higher margins for them and maybe turning that tolerated into something a bit closer to liked, which only strengthens the moat further. 4, leadership and financial strength. A wonderful company.
Okay, let's talk leadership and the financial nuts and bolts. The CEO, Judy Marks, chair, CEO, and President Xi came on board in 2017, right? And oversaw the spinoff in 2020. What's the take on her leadership?
Yeah, the impression is very positive. Her philosophy seems really clear, rational, definitely long-term focused, very owner-oriented.
How did that come across?
She consistently talks about that flywheel model, calls Otis a long-cycle business.
Yeah.
It shows she really gets the core economics, and her public stance, especially when things are uncertain, is always about focusing on what we can control. Which sounds, very pragmatic, like a solid operator.
Right, not getting caught up in short-term noise.
Yeah.
And does that philosophy translate into how they handle their money, capital allocation?
It absolutely seems to. Our analysis suggests their capital allocation is exceptionally rational and very shareholder-friendly.
Okay, break that down. Where does the cash go? Reinvestment, acquisitions, giving it back to shareholders.
All three, but in a very measured way. Reinvestment first. CapEx is pretty modest. R&D is only about 1.4% of sales, which might sound low, but it's highly focused.
Focused on
things that widen the moat. Digitalization, like Otis One. Developing new, more efficient product platforms that will feed the service space later. Smart spending, not just spending for spending's sake.
Makes sense. What about acquisitions? Buying other companies.
Very disciplined here. They do what are called bolt-on acquisitions. Small deals, usually buying regional service companies.
Yeah.
This directly accelerates the growth of that high-margin service portfolio. In 2024, for instance, they spent about $87 million on roughly 30 small deals like this.
So no giant risky mergers.
Exactly. It's the total opposite of risky empire-building M&A you sometimes see. Very strategic.
Okay, and shareholder returns. Dividends, buybacks.
Very strong focus here. They've raised the dividend every single year since the spinoff. It grew cumulatively 110% by early 2025, but the payout ratio is conservative, around 40% of earnings, so it's sustainable.
Room to grow it further.
Definitely. And they do significant share repurchases, too. $1 billion in 2024 alone. Over $5.6 billion bought back since 2020. And they just authorized another $2 billion program earlier this year. So clearly returning cash to owners is a priority.
That does sound like a solid, balanced approach.
Yeah.
What does this all mean for the company's overall financial health? Is it like a financial fortress?
It really is. And that strength flows directly from the business model we discussed. Look at return on invested capital, ROIC.
The key profitability metric.
Right. It's exceptionally high.
Yeah.
Now, how you calculate it can vary based on accounting treatments, especially after the spinoff.
Okay.
But the reported figures we saw range from a very strong 19.5% all the way up to, frankly, a staggering 72.6%.
Whoa. That's a wide range, but even the low end is great.
Exactly. Even at the low end, it's far, far above their cost of capital, which is estimated around 7.8%. It's just a clear sign of a superior business generating fantastic returns on the money invested in it.
Okay, what else points to financial strength?
Free cash flow conversion. This is crucial. Does the accounting profit actually turn into real cash the company can use?
Good question.
And for Otis, the answer is yes. They consistently convert. Management actually targets converting over 100% of their GAAP net income into free cash flow. They hit about 97% in 2024. That shows really high earnings quality. The profits are real.
It's just accounting artifacts.
Right. And finally, the balance sheet. It's prudent, conservative. Their net debt to EBITDA ratio at the end of 2024 was around 1.87x. That's very manageable. Gives them plenty of flexibility, capacity to handle debt.
Yeah.
It's strong.
So, yeah, elite ROIC, strong cash conversion, solid balance sheet. You put that all together.
It really does paint the picture quantitatively of what you might call a truly wonderful company. The future, growth, risks, and second-level thinking.
Okay, looking forward then. What's the biggest driver, the main engine for Otis's future earnings growth? Where's it going to come from?
It seems pretty clear. Modernization. taking those millions of older elevators already installed around the world and upgrading them.
And this isn't tied to new construction cycles.
Not really. This is a secular trend, meaning it's long-term and driven by the age of the equipment, not just economic cycles. Like we said, that number of units needing modernization is huge and growing from 8 million now towards over 10 million by 2030.
And Otis is positioned to capture that.
They seem to be. They're reporting double-digit growth in modernization orders. And importantly, modernization work is high margin, just like service, and it tends to strengthen the customer relationship, locking them in even tighter. It feeds the flywheel beautifully.
Okay, sounds promising. But no company is without risks, right?
Oh.
What are the real long-term threats? Things that could genuinely permanently damage this business?
Yeah, you always have to consider those. We see three main ones. First, technological disruption. Imagine if a competitor, or even a tech company, developed an open-source diagnostic system for elevators. Or if right-to-repair laws, like we see for phones and tractors, spread to this kind of industrial equipment.
That could break the proprietary lock-in, lower switching costs.
Exactly. It could potentially commoditize the service business, which is their profit engine. That's a big one.
Mm-hmm.
Second, catastrophic reputational damage.
Because it's a safety business.
Precisely. Their brand is trust. A major, high-profile safety disaster linked to their equipment or service. Or a massive ethics scandal. That could permanently tarnish the brand in a way that's hard to recover from.
Yeah, that makes sense. And the third risk?
China, a permanent structural decline there. The current slowdown in new construction is one thing, likely cyclical. But imagine a lasting geopolitical break or a genuine depression in the Chinese property market. It's the world's single largest elevator market.
So a permanent hit there would significantly shrink their total potential market.
Significantly. So those are the big three long-term worries. Tech disruption, reputational damage, and a structural decline in China.
Okay. This leads into something called second-level thinking, going beyond the obvious. The market generally seems to rate Otis as just a hold. Why is that, and what might they be missing?
Well, the main reason for the lukewarm hold rating seems to be that cyclical downturn in China's new equipment market. It's dragging down overall sales growth figures.
So the market is focused on the weak part of the business.
So it looks like classic short-term thinking. Yeah. Over-focusing on the cyclical, low-margin part of the business.
And maybe missing the bigger picture.
Exactly. Fundamentally underappreciating how durable and increasingly important that high-margin service and modernization flywheel is. And here's the really interesting second-level insight. That slowdown in China's new equipment sales, it's actually been a catalyst. It's forced Otis management there to accelerate their pivot away from relying on low-margin new sales and towards building up the higher quality, more profitable service and modernization business within China itself.
So the short-term pain is actually driving a long-term positive strategic shift.
That's the argument. While it hurts reported sales growth now, shifting the focus in China towards service and mods is actually good for the quality of Otis's overall earnings stream and the fundamental strength of the business long term. The market might be missing that strategic improvement hidden within the weak headline numbers. 6. The Red Team Challenge. Inverting the thesis.
All right, so we've built a case for Otis being a high-quality business with a strong moat. But we always do this red team challenge. We try to actively poke holes in our own thinking.
Invert, always invert.
Exactly. So what's the strongest argument for why investing in Otis today could turn out to be a long-term mistake? What are we potentially misjudging?
It really comes down to one core thing, fundamentally misjudging how permanent that economic moat actually is.
Okay.
The inverted scenario, the red team case, is basically this. What if that incredibly profitable service business isn't secure? What if it's actually right on the verge of being disrupted and commoditized?
How could that happen? What would that look like?
It'd likely be a combination of things. Regulatory forces and technological forces hitting at the same time.
Like?
Imagine governments stepping in with broad right-to-repair laws specifically for industrial equipment like elevators, forcing OEMs like Otis to open up access.
Making those proprietary tools, the software, maybe even the parts available to independent repair shops.
Yes. And then layer on top of that, imagine a well-funded competitor, maybe even a big tech company looking for a new market, develops a more open-source elevator platform. Something designed from the ground up to not lock customers into proprietary service.
Okay, so regulations force openness on the old stuff, and new tech prevents lock-in on the new stuff. What's the result?
The result is that competent, independent service companies suddenly have the tools and the access they need. They can offer service that's just as good as the OEM, potentially, but at a significantly lower price.
And those customer service complaints we talked about.
They suddenly matter. Right now, customers tolerate slow service or billing errors because switching is too risky or difficult. But in this red team world, those problems become immediate reasons to jump ship to a cheaper, maybe even more responsive independent provider.
So that 94% retention rate.
It crumbles. Building owners, no longer trapped by switching costs or proprietary tech, would flock to lower-cost options. And that river of high-margin service money that makes up over 90% of Otis's profit, it just dries up.
Replaced by a competitive, price-sensitive market. Brutal.
Absolutely brutal. The consequences would be dramatic. ROIC would collapse because the high returns came from the service annuity. Free cash flow would evaporate. Those nice dividend hikes and share buybacks, they'd stop. The wonderful company financial profile disappears.
And this whole red team scenario really hinges on something we found in our research.
Those persistent customer complaints.
Exactly. They might seem minor now, given the retention rate, but they signal this underlying tension, a vulnerability, a potential crack in the fortress that a disruptive force, regulatory or technological, could exploit to break that whole flywheel model permanently. Outro. And wow, that brings our deep dive into Otis Worldwide Corporation to a close. We've covered a lot of ground, haven't we? From understanding that hidden profit engine in the service business.
Yeah, the fly.
Its really formidable moat, that fortress protecting it, and the weird paradox of its customer service being, tolerated, not left.
Mm-hmm. And the solid leadership, strong financials.
Right. And then looking ahead at the growth from modernization, but also those key risks and the red team challenge.
Otis is just a really fascinating case study, I think. It shows what enduring business quality can look like, but also it reveals those subtle vulnerabilities that can hide even inside what seems like the strongest moat.
Absolutely. So, as you go about your day, maybe riding an Otis elevator, here's a final thought to chew on. If a company's powerful competitive advantage really hinges on its customers feeling like they have, quote, no better or safer alternative, what does that really tell us about how powerful businesses operate in these essential, heavily regulated industries?
That's a deep question.
And could that ongoing customer dissatisfaction, even if it's tolerated now, actually be planting the seeds for future disruption, regardless of how strong that moat looks today? Something to think about.
Definitely food for thought.
Thank you so much for joining us on this deep dive. We'll catch you on the next one.